What if everything you believe about safe money is actually the biggest financial illusion of modern times? Imagine working your whole life, saving carefully in your national currency, and then waking up one day to find that your savings can suddenly buy only half of what they used to. Not because you made a bad investment, not because you took risk in the market, but simply because the currency itself lost value. This is exactly the kind of silent financial shock that most people never prepare for. And it is the central reason why gold has always been treated as something far more powerful than just an asset. Welcome to Gold Silver Scope, where we break down gold and silver through real economic truth, not financial illusion. Gold has one unique feature that separates it from every form of paper money in the world. It carries no financial liability. That means it is not someone else's promise, not a government IOU, and not dependent on a banking system to maintain its value. It exists independently of debt. And in times of crisis, that difference becomes everything. Take the example of currency collapse scenarios like Iceland in 2008. When a currency suddenly loses half its value, people who hold that currency directly experience a collapse in their standard of living. Prices rise overnight, savings shrink in real terms, and imported goods become dramatically more expensive. But those who held gold during such periods were largely protected from that destruction of purchasing power. This is why gold is often described not as a get-rich asset, but as a survival asset. It does not rely on growth, speculation, or promises. It relies on preservation. And preservation becomes most important when systems break down. Unfortunately, most people around the world live under what can be called the "it won't happen here" mindset. They believe that currency crises only happen in other countries, in weaker economies, or in extraordinary situations. But history repeatedly proves otherwise. Currency devaluation is not a rare event. It is a recurring cycle in debt-driven systems. When people have never experienced a currency collapse before, they tend to underestimate how fast it can happen. Economic history shows that once debt expands beyond control, there are only two possible outcomes. Either the system corrects through a painful contraction, or it continues expanding until the currency itself loses value. In most modern systems, governments and central banks tend to delay correction by increasing liquidity, pushing problems further into the future. But delaying a problem does not remove it. It only increases its size. This is where gold plays its most important role. It acts as a form of financial insurance against monetary instability, political uncertainty, and excessive currency creation. While paper currencies are constantly influenced by policy decisions, interest rates, and central bank actions, gold remains outside that system. Unlike money printed by governments, gold cannot be created through policy decisions. It cannot be expanded to cover debt. It cannot be devalued through interest rate manipulation. That is why in moments of crisis, whether inflation shocks, banking stress, or geopolitical tension, gold consistently holds purchasing power better than paper currency. And this is not just theory. It is a pattern repeated across financial history. Every major debt expansion eventually creates pressure in the system. As debt builds across governments, households, and corporations, the stability of the currency becomes more dependent on continuous intervention. The more the system relies on intervention, the more fragile it becomes underneath. Gold exists outside that fragility. It does not depend on confidence in governments or central banks. It does not require economic growth to maintain its value. It simply exists as a neutral form of wealth that has survived every monetary system in history. And that is why, when financial stress begins to build, gold does not behave like a normal investment. It behaves like protection. To understand why gold matters so much in today's financial system, we first need to understand what is really happening to money itself. Most people think inflation simply means prices going up. But in reality, Inflation is much deeper than that. Inflation is not just a rise in prices, it is a decline in the value of money. And that decline happens quietly, slowly, and continuously over time. When governments and central banks expand the money supply, they are not just stimulating the economy. They are increasing the total amount of currency in circulation. And when more currency enters the system, without a matching increase in real goods and services, each unit of money becomes less valuable. This is why, over time, everyday life becomes more expensive. Food costs rise, rent increases, energy bills climb, education and healthcare become harder to afford. It is not because everything is becoming more valuable. It is because the currency is losing value. This is one of the most misunderstood realities in modern economics. Governments often avoid directly admitting this. Instead, inflation is usually explained through external factors: supply chain issues, geopolitical tensions, or temporary disruptions. While these can influence short-term price movements, the long-term and consistent driver of inflation is monetary expansion. When governments accumulate large amounts of debt, they face a difficult problem. The debt must be serviced and eventually repaid. But instead of reducing spending or restructuring obligations, many systems rely on expanding the money supply to manage the burden. This process is subtle but powerful. It does not erase debt directly. Instead, it reduces the real value of that debt over time by lowering the purchasing power of the currency used to repay it. In simple terms, debt is paid back with money that is worth less than when it was borrowed. This creates a hidden transfer of wealth. Savers lose purchasing power. Wage earners find their income stretched thinner. Meanwhile, those closest to new money creation, such as financial institutions and governments, benefit first from the newly created liquidity. This is why inflation is often called a silent tax. It does not appear on a tax form, but it gradually reduces the real value of everyone's savings. Over time, the effects compound. What once cost a small amount becomes significantly more expensive. What once felt like financial security slowly loses its strength. People may not notice the change year by year, but over decades, the impact becomes extremely clear. This is also why many individuals feel that they are working harder just to maintain the same standard of living. Even when incomes rise, expenses tend to rise faster. Now, when we look at this system through the lens of debt, the picture becomes even more important. Modern economies have gone through one of the largest credit expansions in history. Governments, corporations, and households have all increased borrowing over time. This expansion has allowed for economic growth, but it has also created a deep dependency on cheap and continuous credit. When credit expands, it creates short-term stability and growth. But when credit becomes excessive, it creates long-term vulnerability. At a certain point, debt levels become so large that normal repayment through real economic output becomes difficult. At that stage, the system begins to rely heavily on refinancing, low interest rates, and central bank intervention to maintain stability. This is where risk builds silently in the background. Because once debt reaches extreme levels, the system becomes sensitive to even small changes in interest rates or lending conditions. If borrowing becomes more expensive, refinancing becomes harder. If lending slows down, liquidity tightens. And when liquidity tightens in a highly indebted system, stress spreads quickly. This is why financial cycles often end in one of two ways. Either the system goes through a painful contraction, where debt is reduced through defaults, bankruptcies, and asset devaluation, or the system responds by increasing liquidity further, which can weaken the currency itself over time. Both outcomes carry consequences. In a contraction, asset prices fall and credit becomes scarce. In a monetary expansion response, currency value declines and purchasing power weakens. In both cases, the pressure ultimately falls on the individual saver. This is where gold becomes structurally important. Gold does not rely on credit. It does not depend on debt expansion. It is not tied to banking stability or government promises. Instead, it exists outside of the credit system entirely. So when financial systems become unstable, whether through tightening credit or excessive money creation, gold tends to act as a stabilizing force in terms of long-term purchasing power. It does not guarantee short-term profit. It does not eliminate volatility. But it does something more important in a fragile system. It preserves value when the currency system is under pressure. And this is exactly what makes gold different from traditional financial assets. Stocks, bonds, and cash are all tied in some way to financial promises. They depend on performance, repayment, or policy decisions. Gold does not depend on any of these. That is why during periods of financial stress, gold often behaves differently than other assets. It is not driven by earnings or interest rates in the same way. It responds more directly to fear, instability, and loss of confidence in currency systems. As global debt continues to grow, this dynamic becomes more relevant. The higher the debt burden, the more pressure there is on monetary systems to manage stability. And the more intervention required, the more important it becomes to understand what protects wealth outside that system. To really understand gold's role in the global financial system, we need to look at something most people rarely think about: central banks themselves. Central banks are the institutions that control the supply and flow of money in modern economies. They have the power to expand or contract the money supply, influence interest rates, and shape overall financial conditions. In simple terms, they sit at the center of the monetary system. But here is the important contradiction. Even though central banks control paper money, they do not fully trust it themselves. This is why, despite relying on fiat currencies for policy, central banks around the world continue to hold gold as part of their reserves. This creates an important signal. If paper currency alone was fully reliable as a long-term store of value, there would be no need for gold reserves. Yet gold remains a core asset on central bank balance sheets across the world. The reason is simple. Gold acts as a hedge against currency risk. Fiat currencies are flexible. They can be created, expanded, and adjusted based on economic conditions. This flexibility is useful in managing crises, but it also introduces long-term risk, the risk of gradual currency devaluation. Gold does not carry that risk in the same way. It cannot be expanded by policy decisions. It cannot be created to finance government deficits. It exists independently of the banking system. This is why gold remains a strategic reserve asset. Now, when central banks respond to crises, such as financial crashes, recessions, or global disruptions, they often inject liquidity into the system. This means increasing the money supply to stabilize markets, support lending, and prevent economic collapse. In the short term, this can prevent deeper financial damage. It can stabilize banking systems and restore confidence. But over time, repeated liquidity expansion can weaken the purchasing power of the currency itself. This is the key trade-off in modern monetary policy: stability today versus currency strength tomorrow. And this trade-off is not theoretical. It has been repeated many times across economic history. During periods of crisis, central banks often expand balance sheets significantly. This includes buying financial assets, lowering interest rates, and providing emergency lending facilities. These actions help prevent immediate collapse, but they also increase the long-term supply of money in the system. As money supply expands faster than real economic output, currency value gradually declines relative to hard assets. Gold reflects this imbalance. This is why, over long periods of time, gold tends to maintain its purchasing power, while fiat currencies slowly lose theirs. Now here is where the system becomes even more interesting. While central banks actively manage paper currency systems, they also hold gold as a form of stability reserve. This means they are simultaneously managing a system that depends on trust in currency, while also holding an asset that does not depend on trust at all. This dual approach highlights a key reality. Even institutions that control money recognize the importance of something outside the system. Gold represents that outside element. It is not tied to political promises. It is not dependent on fiscal discipline. It is not influenced by interest rate policy in the same direct way as bonds or currency markets. Instead, it acts as a neutral reserve of value that can support financial confidence when needed. This is especially important during periods of global uncertainty. When markets experience stress, capital tends to move toward assets perceived as stable and independent. Gold often benefits in such environments because it is not linked to the solvency of any single government or banking system. It becomes a form of financial insurance at the institutional level, not just for individuals. This leads to a deeper insight. Gold is not just an investment asset, but a monetary anchor. Even as financial systems evolve, expand, and become more complex, gold remains a reference point for value. It is one of the few assets that exists outside the credit structure that dominates modern finance. Now, when we connect this back to debt, the picture becomes even clearer. As global debt levels rise, financial systems become more sensitive to interest rates, refinancing conditions, and liquidity cycles. Central banks often find themselves needing to balance stability with currency integrity, but maintaining both at the same time becomes increasingly difficult as debt grows. This is where gold quietly gains importance again, not because it changes, but because the system around it becomes more unstable. When confidence in currency weakens, even slightly, gold's role as a neutral store of value becomes more relevant. It does not need to be actively managed to perform this role. It simply exists outside the system, which is exactly what makes it valuable in systemic stress. And this is why gold continues to appear on central bank balance sheets, even in a world dominated by digital money, credit expansion, and complex financial instruments. It is not there by accident. It is there because it serves a function that no other asset fully replaces. One of the biggest financial misunderstandings in the modern world is not about markets, interest rates, or even debt. It is about the psychology of money itself. Most people believe that holding cash is the safest possible position. It feels stable, familiar, and secure. You can see it, you can count it, and you can store it in a bank account. Because of this, fiat currency is often treated as risk-free in everyday thinking. But in reality, cash carries one of the most overlooked risks in the entire financial system: currency devaluation. This is the quiet risk that most people do not monitor day to day. It does not show up as sudden losses like stocks or crypto. Instead, it works slowly in the background by reducing purchasing power over time. This is why inflation feels so confusing to many people. Even when they are saving consistently, they often feel like they are not getting ahead. Their income may increase, but their lifestyle improvements are limited. Expenses rise in parallel, gradually reducing the real value of what they earn and save. This creates a psychological illusion. People think they are stable because their account balance does not disappear overnight. But in reality, their purchasing power is steadily eroding. This is where the "it won't happen here" mindset becomes very dangerous. People naturally assume that serious currency problems only happen in unstable or developing economies. They believe major currencies are immune to collapse because they are widely used, globally trusted, and supported by strong governments. However, history shows that currency weakness is not limited to any one region. It is a systemic outcome that can affect any fiat currency when debt levels, monetary expansion, and economic pressures combine over time. The key issue is not sudden collapse. It is gradual erosion followed by occasional sharp adjustments. Most people do not notice the gradual part. They only react when the sharp part happens. This is why currency crises feel sudden, even though the conditions building them are long-term. Another important psychological factor is that people evaluate risk based on visibility. If something fluctuates in price daily, like stocks or gold, it feels risky. But if something is stable in nominal terms, like cash in a bank account, it feels safe. However, stability in nominal value is not the same as stability in real value. Cash may appear stable because one unit is always equal to one unit, but what that unit can buy changes over time. And that change is the real measure of wealth. This is where gold plays a completely different role in perception and reality. Gold is often misunderstood because it is volatile in the short term. Its price moves up and down in relation to currency. This leads many people to assume it is risky. But this is a framing error. The real question is not, does gold fluctuate? The real question is, does gold preserve purchasing power over long periods of monetary change? Historically, gold has performed that role more consistently than fiat currencies. While currencies lose value through inflation and policy expansion, gold remains independent of those systems. It does not rely on central bank decisions or government balance sheets. It exists outside the credit structure that defines modern money. This is why gold is often described not as a speculative asset, but as a form of monetary insurance. Insurance is not meant to generate excitement or short-term gains. It is meant to provide protection when conditions become unstable. And in financial systems built on expanding debt, instability is not an exception. It is part of the cycle. When debt rises across governments, households, and corporations, financial systems become increasingly sensitive to changes in interest rates and credit conditions. Even small shifts can have large effects because the system is leveraged. In such an environment, liquidity becomes central. If credit is easy, the system expands. If credit tightens, pressure builds quickly. Most individuals are exposed to this system whether they realize it or not. Their savings, pensions, wages, and investments are all tied to the performance of a currency system that is constantly being adjusted. But the average person does not track currency strength or long-term monetary trends. They focus on income, expenses, and short-term financial goals. As a result, they often miss the slow erosion happening underneath. This is why financial awareness at the currency level is so important. Because once you understand that money itself is not static, your entire perception of saving and investing changes. Cash is no longer simply safe. It becomes an asset exposed to long-term devaluation risk. And this is where gold enters the picture again, not as a replacement for currency, but as a balance against it. It provides a counterweight to systems that expand and contract based on policy decisions. It does not eliminate uncertainty, but it helps absorb it. And that is why, across history and across different economies, individuals who understand currency risk tend to treat gold differently than those who do not. When you step back and look at the entire financial system, one idea becomes increasingly clear. Control over money is control over wealth. Modern economies are built on fiat currency systems, where central banks and governments have the ability to expand or contract the money supply. This means the value of money is not fixed. It is actively managed based on economic conditions, political decisions, and crisis responses. In such a system, the average person does not control the value of their savings. They only hold the currency that is being managed by larger institutions. This is where gold introduces a completely different concept. Gold allows individuals to step outside the traditional monetary system. It is not dependent on central bank policy, it is not tied to government debt, and it is not created through credit expansion. Instead, it exists as a neutral form of value that has been recognized across civilizations for thousands of years. This is why gold is often described as a way of becoming your own central bank. A central bank's role is to preserve and manage the value of currency over time. But when currency itself is subject to continuous expansion and devaluation, the stability it promises becomes less certain. Gold, on the other hand, does not require management to maintain its core function. It does not depend on trust in institutions or policy consistency. It simply retains value across different monetary environments. This is especially important in a world where debt levels are historically high. When economies carry large amounts of debt, there is constant pressure on policymakers to maintain stability. This often leads to lower interest rates, liquidity injections, and monetary expansion during periods of stress. While these actions can prevent immediate crises, they also contribute to long-term currency dilution. Over time, this creates a system where saving in currency alone becomes increasingly dependent on continued policy stability. But policy is not static. It changes based on economic conditions, political priorities, and global events. Gold exists outside this cycle. It does not require repayment. It does not depend on credit markets. It does not carry counterparty risk. It is not someone else's liability. It is a standalone asset. This is why, in periods of uncertainty, gold often becomes more relevant not because it changes, but because the system around it becomes less predictable. When financial systems are stable, gold may appear less necessary. But when systems become stressed, through inflation, debt expansion, banking pressure, or geopolitical tension, gold's role becomes much clearer. It acts as a stabilizer in a system built on constant movement. And this brings us to a deeper philosophical point about money itself. Most people think of money as something stable and permanent, but in reality, modern money is dynamic. Its value changes over time based on supply, demand, policy decisions, and global confidence. This means financial security is not just about earning or saving. It is about understanding what is happening to the value of what you are saving. If money loses value slowly over time, then simply holding it is not enough to preserve wealth. This is where assets like gold become important as a balancing mechanism within a broader financial strategy. Gold does not eliminate risk. No asset can do that, but it changes the structure of risk exposure. Instead of being fully dependent on a single monetary system, individuals who hold gold introduce an element of independence into their financial position. This is why gold has historically been treated as a form of protection rather than speculation. It is not about timing the market. It is about recognizing that monetary systems evolve, expand, and occasionally experience stress. And in those moments, assets that exist outside the system tend to behave differently from those inside it. This is also why central banks themselves continue to hold gold. Even at the highest level of monetary control, gold is still recognized as a reserve asset that provides stability when currency systems face pressure. That alone is a powerful signal of its role in the global financial structure. Ultimately, the key takeaway is simple. Financial systems change, but gold's fundamental role does not. It remains a store of value across different economic cycles, different policies, and different levels of debt expansion. And for individuals, understanding this dynamic is not about fear, it is about awareness. Because once you understand how currency value changes over time, you begin to see why diversification beyond fiat money becomes important in long-term wealth preservation. This is the core idea behind financial resilience. Not relying on a single system, but positioning yourself in a way that can withstand change. Gold represents that principle in physical form. Final call to action. If you found this breakdown valuable, make sure to stay connected with Gold Silver Scope, where we continue breaking down real economic forces shaping gold, silver, and global money systems in simple and practical terms.